Hello, everyone, and welcome to another amazing episode of Sphere of Being, which, as we know, is all about making sure that we show up in the best way possible so that we can be in business as well as in our personal lives, the person that really does make a difference to others, but still keeping ourselves in that optimum mode without burnout, without stress and anxiety to make sure that we are the best that we can be. And as you know, it is my mission to scour internationally those guests that are going to make such a difference to our lives in a business perspective. And today is absolutely no difference. It is an absolute privilege and a pleasure to have with us today a gentleman who has not just one, but two international Amazon #1 best-selling books. Absolutely incredible author. He is an acclaimed public and keynote speaker. Yay!
So let me take that.
Absolutely. Add their multiply and funded female founders, not to be said after a drink or two. Because this gentleman is, I mean, he really does walk the talk. He's done it with his own business. He helps through Add Then Multiply as a consultant to really help small business founders to grow exponentially but sustainably. And he's done it for himself. So he does what he does on the tin. He walks the talk. He's absolutely fantastic through lived experience. The next is Funding Focus, which is a social enterprise where he wishes to level up the playing field for females and underrated entrepreneurs to really excel in what they're doing. And as we saw the book there, which is Funded Female Founders. Gosh, I do realize I've gone back to my elocution lessons that with that, it's how female founders have the right and are worthy and deserving of the funding because we love the guys too, but it's a girl power, which is absolutely fabulous. And another thing, he has a TEDx talk that has over 3 million views. So I know he's going to talk about it anyway, but get on down there and have a listen because this gentleman can really transform your business. David B. Horne, welcome to the Sphere of Being podcast.
Thank you, Deborah. It's a delight to be here.
Oh, wonderful. And so mild and humble as well. I mean, it's wonderful about you. You're just such a wonderful personality as well. It's lovely
Thank you.
to have you on the show. So let's kick in deep. Let's find out what was it as you started off as an accountant with PwC. So there's been a bit of a change going on in your career. What was it that the catalyst that made you think, right, add then multiply? This is my purpose.
So I had been in a corporate career initially with big blue chips, and then with medium-sized listed companies. I had been the chief financial officer of two different companies listed on the London Stock Exchange, and I'd done a lot of M&A work and I'd done a lot of fundraising work, and I burned out at the end of 2010. And I had my midlife crisis and tried to launch a wine business, which was great fun, but not very successful.
I'm sure you
Um,
drank a few of your profits. Yeah.
I certainly drank most of the profits and then some. Absolutely, absolutely. But it was an experience that had to be gone through, and as a result of that, I came to the view that, well, assisted by my wife, that the wine business wasn't going to support our family the way they were accustomed. And so I thought, well, I'll go back and build up my consulting practice, and initially just kind of or not go, we'll go back and build up a consulting practice, I should say, um, focusing on providing finance services. And at first, I kind of drifted a bit. I'd lost my mojo as a result of the wine business, and I kind of drifted around for a while. And then I came across a few people who had a big, big impact on my life and did a few programs that had a big, big impact. And as a result of doing that work, it became very clear to me that actually the skill set that I had learned during those 8 years as the CFO of two listed companies and raising capital and buying other companies was something that not a lot of people had, and that not a lot of entrepreneurs realized was something that was accessible to them. And so that's what led to the publication of the Add Then Multiply book, which is all about my kind of what I call my FACE methodology, FACE, fund, acquire, consolidate, and exit. And that led to the development of the Add Then Multiply practice, which has been growing consistently over about the last 5 or 6 years.
This is amazing because you make it all sound so easy, and I know that there's a lot of hard work that goes on behind the
Yeah,
scenes.
yeah,
So, yeah, absolutely beautiful. And then taking us on to the next stage of what your social enterprise work with funding
yes.
focus. Tell us all about that.
So shortly after the first book came out, I started to get invited to speak at events. And I was speaking at an event in the summer of 2019 about fundraising for small businesses. And a woman came up to me after my talk and asked why so little funding went to female founders. And I looked at her and I said, I have no idea, but I'll find out. And Deborah, what I found out shocked me. At that stage, there'd been a report just published by the British Business Bank that looked at every venture capital deal in the UK in 2017. And it found out that out of every pound of venture capital invested, less than a penny went to all female teams.
No.
About 10p went to mixed gender teams, and more than 89p went to all male teams. And
Oh,
this despite the fact that women submitted 5% of the pitch decks and got less than 1% of the money. And I've since gone on and researched it further and found more statistics around the UK and North America. In the UK, there's data going back till 2008. The level has only once in 2008 been more than 2% of the total. It currently sits on 1.9, but it's never broken through 2% since then. And in the United States, it's never broken through 3%.
wow. I'm going to ask the question, why?
Um, Three fundamental reasons from my perspective, based on the research I've done and the people I've spoken to. Number one is inherent gender bias. And, the situation's better than it was 50 years. When I was a kid growing up, it's funny. I occasionally I'm, skipping through Netflix and find an old TV show that I watched when I was a kid, and I watch it now, and I think, my God, they couldn't get away with that kind of a approach to women and that was just an example. But it's still it's still a very strong inherent gender bias against women. Secondly, there is a disproportionately low number of women in the fund management industry. When I was first researching this, following the question that woman asked me, we put on our first ever event in November of 2019, and a week before our event was published, or sorry, our event went live. A report was published by Morningstar, a big media company, and they had looked at all of the fund managers of all of the listed funds in the UK, and at the time there were about 1,500 of them. And they found that 108 funds were run by men named David, which I thought initially was kind of cool. And then the next thing I discovered was that only 105 funds in total were run by women. So you got more Davids running money than you've got
Have
women running
women.
money. And 105 out of 1,500, that's 7%. It's tiny. I mean, it's better than the 1% of funding that's going to female founders, or 2% that's going to female founders, but it's still disproportionately low. And the third thing, and I've discovered this time and again, and I still deal with it when I'm coaching female founders and working with them on their pitch decks and things, is women tend to be very, very conservative in their projections.
Yeah.
And I'm looking at a situation right now, and the first draft of the pitch deck I got said, here's a business, and we're valuing it at I think it was £10 million, and here's our financial projections, and by year 5 we'll be making £5 million of revenue and 300 grand in profit. And they're trying to raise £1 million, and I'm just thinking, that's not going to get any investor excited. They're looking for taking off. They want 10 times that kind of a target. And so it's really, really important for women to be more aggressive, be more confident in their forecasting, because ultimately investors are looking for a high return. They know that if they're investing in an early stage business, it's high risk. And so they've got to see the potential of high return, or they're just not going to be interested.
And doesn't this come down to the psychology of the fact between the wonderful guys and the wonderful ladies, in a sense that take us through the process because you are helping people to level up, but also you're an amazing, I want to say consultant, coach type of person that can take people through limiting
Yeah.
beliefs or what have you. but I don't want to take words out of your mouth. The difference between men and women coming at this process of funding, what have you seen, and how do you help people to, as you say, level up this playing field?
Well, men are more ballsy, men are more aggressive, men are more, testosterone driven. And you might have the same set of core financial projections, and it might say that the business is going to need 832,465 pounds or dollars or euros or whatever. And a man will ask for 2 million and a woman will ask for 750,000.
Yeah.
And then when they're projecting the growth of the business, again, particularly for early stage investors, angels, venture capital firms, they are looking for firms that have the potential to take off because they know from their own work that they do and the risk profile of the early stage companies that they're investing in, they know that, a bunch of companies are going to go bust. And they know that a bunch of companies are going to go kind of nowhere and become what they call zombies that just kind of tick over and, they'll keep going, but they're not generating any cash and nobody's going to invest any more into them. They just tick over and they often end up being sold off either back to the founders or to a turnaround specialist. And that leaves out of a portfolio of potential investee companies, two or three that have the potential to really take off. And they have to have that belief that every company that's in the portfolio that they're investing in has that potential because they know that, 10 or 15% of the companies are going to go bust and 75 to 80% of them are going to become zombies. And that leaves kind of 5% of the companies that are going to make the returns for everything, including the write-off of all of the investment that's gone into the companies that are going nowhere or going bust. So you have to be able to demonstrate that your company has the potential in the sort of industry speak to become a unicorn. And a unicorn is a company that has $1 billion valuation. And I know that for a lot of female founders, that's a difficult thing because they're also balancing the fact that, they might be wanting to look at families and they might want to be having a very family friendly organization. And not all of them want to grow to become $1 billion company. And so that throws an extra layer of challenge. And one of the things I'm trying to do is look at other types of funding that will allow female founded businesses to get the funding that they need, but on the basis that they're demonstrating, whilst there may be a lower return, there's also a significantly lower risk.
Now, this is really interesting. I'd love you to unpack some of this because I love this disruptor, this innovative way in which you're looking at creating funds that are different. Because I don't know, do you see the old paradigm shifting in any way right now?
Not really, no. And the reason for that is that most venture capital firms are very, very successful. So the honest venture capitalists admit that they are basically sophisticated gamblers. But the ones who have been around for a while are good gamblers and they're good at spotting the companies that have the potential. And it only needs one company. Let's put this in context. Let's say you go out and raise a fund of 50 million and you're going to invest in 100 companies at 500,000 each. Even if 49 of those, sorry, even if 99 of those companies go bust, all it needs is one company to be all of a sudden sell for 100 million and not only do you pay back the fund but you pay back all the expenses and you pay back a great whacking return as well that gets split between the venture capital firm and its investors. So really that's all they're going for, and most venture capital firms do very successfully. um, Sometimes in my more cynical moments, I describe them as being fat, dumb, and happy because there's no incentive for them to change.
Well, this is
So
it.
what I'm trying to do is look at
Yeah.
how do we create something that doesn't compete with them because they're well established, but something that goes into a space that they don't operate in.
Beautiful. So let's go into that because I'm so pleased we're having this conversation because this is going to be energizing, especially just to let everybody know this is the start of the year and so many people are going to be having so many plans about what they want to have the businesses done to do this year. So talk
Yeah.
us through a little bit about how you're helping to bring something new into the marketplace that people that don't fit within that very rigid confine can actually go, you know what, this is for me.
Yeah. So I'm currently working on a new plan. I've been in touch with my lawyers because there are some regulatory constraints that we have to work around to make sure that that's going to work. But I am looking at creating a new holding company, like a new company that investors will invest into, and that I will actually put my companies and my IP into. And from that holding company, we're looking to go out and acquire a bunch of female founded businesses where they will get some cash and they will get equity in the holding company as well, and we'll create a portfolio of these companies and we'll work together with them. We'll make sure that they're optimized. We'll make sure that we have sufficient funding out of the funds that we're going to raise from investors to make technology investments, because it is so important now that companies are investing in AI and in broader technology. And for a lot of smaller businesses, it sounds scary and it's like a lot of money and they're not sure they've got it. So I'm going to make sure that as part of what we're doing to raise this investment fund, we allocate a certain amount of capital to deliver against this and actually to provide the funding that will allow us to create AI agents and AI tools and AI bots and all of the other stuff that's coming. And it's coming at such a fast pace.
Mm.
We're still in the very early stages of it. I see AI being one of the dominant forces for at least the next 10 or 15 years. Kind of like when the internet came along at the end came along and started to be really
Yeah.
commercialized at the end of the 90s. We had the dot-com boom and crash, but so much since then has evolved and developed. And I wouldn't be surprised to see, we're certainly in the middle of an AI boom. I wouldn't be surprised to see an AI crash at some point in time because the market's getting very frothy. But there's no question in my mind that AI is the next major technological change that we're going through. I mean, some people I follow are likening it to the coming of the industrial age and the steam engines.
Well,
It's that big of a potential to
the
to disrupt.
revolution, the whole disruption, the revolution, and it's just like it's here, whether we like it or not. And it's
Yeah,
understanding this process. And I'd love you now to, with the AI theme, going back to add, then multiply with the
yeah,
exponential growth for small business founders, because a lot of
yeah.
these ladies will be in a situation at some stage of developing a small business. I'd love you to think about how the AI perspective can actually really get behind an organization and propel them into that exponential but sustainable trajectory.
Yeah. I mean, I think I think the real opportunity is the efficiency and speed, if it's done properly, that AI tools allow us to do. You read a lot of stuff in the media about, oh, these jobs are going to go away and all of that. And there is unquestionably going to be disruption, and absolutely some jobs are going to go away, but there are also going to be new jobs coming along. And I think anyone who has the ability to code AI is going to be in great shape. I think anyone who's has the ability to really analyze and understand data is going to be in good shape. And I think for a lot of people, and I mean, I look at my own professional background, I'm trained as a chartered accountant. The world of accountancy is changing immeasurably, and the number of tools that are coming out that are going to replace a lot of the, routine basic accounts payable functions, accounts receivable functions, journal entry, management reporting, all that kind of stuff. But the things that are uniquely human, where there's the analysis and the comparison and the let's look at this a little bit differently. Like the AI tools can go in and calculate things and do things at a blistering pace, but they don't have the analytical side, at least not yet. And I know that some of the people I talk to are saying that's
Well,
coming,
maybe
and
it's
we'll
here, but
we'll
it's
we'll
not in the
see.
common domain yet. Yeah.
We'll see. But the ability to gather that kind of information and then to say, okay, so the AI is telling us this. What do we need to change within our business in order to maximize the value on that? And of course, the other key thing, and again, we're still at the very early stage, but sometimes the AI gets it horribly wrong. The large language model is coded based on whatever information it has. But if something in there doesn't quite work, and there have been a few public examples of that, I can't think of one off the top of my head, but you know, just Google LLM AI failures or something like that, and you'll things will come up where the AI just got it wrong.
And now bringing the human element in it, because David, this is beautiful what you're telling us now. When we're thinking about the human beingness of being in business, what are you helping with in your consultancy with Add Then Multiply to take small business founders and who dream in big, who are thinking big, and actually get that whole process so that it can exponentially grow, but still keep some sanity in the organization so that you know that it's not going
Yeah,
to go
yeah,
to the unmanageable state.
absolutely. So two things really. Pardon me. The first thing that we do is we we provide fractional finance teams that we can put into businesses. So we'll go into a business and we'll put in a part-time finance director and a part-time financial controller and part-time or full-time bookkeepers and credit controllers and things like that, depending on what the business requires, but scaled to and focused on where the business is at and where it's going. And the reason we do that is one of the things I've discovered over the years is that most entrepreneurs are pretty good at sales and marketing. And many entrepreneurs are pretty good at operations and logistics. And most entrepreneurs don't understand finance, and they kind of shy away from it, and they just sort of, oh well, I'll give that to the accountant, and they go and they find a cheap bookkeeper and a cheap external accountant, and all they get is compliance. They don't get any strategic input, they don't get any analytical input, they don't get anything that really says here's where your business is going. And I often liken it to a three-legged stool or a tripod, where sales and marketing is one leg, operations and logistics is one leg, and finance is one leg. And if you've got a tripod that's standing with three solid legs, it's very, very hard to knock it over.
Mm.
But if you've got a tripod that's got two solid legs and one of them that's weak, it just falls over immediately. And one of the key things that a lot of entrepreneurs don't always realize is when they raise investment funding, the investors are going to demand a lot of analysis, a lot of data, a lot of reports, particularly if you've got angel investors or venture capital firms who sit on your board. They're gonna want detailed packs. They're gonna want detailed analyses on all manner of different things, and a lot of that ends up coming down to your finance team and their ability to produce that data. And I've gone into clients where they've just not been ready for that, and it's been a real scramble to pull that data together.
Mm.
They can do their quarterly VAT return and they can manage to get their accounts produced. But sometimes when, especially with venture capital, they're incredibly data hungry again because they're so focused on, are we on track to getting this business to where it needs to get to become a unicorn? And data is what they use to drive it. So it's really important that the finance fundamentals are really strong and as strong as the sales and marketing and operation fundamentals. So that's the first part that we do.
And
And
with
then after that,
Sorry, I was
go
just
ahead.
going to say, because I'd love to come in. You mentioned your proprietary framework model,
Yes,
FACE. Do you use
yes.
that when you're looking at add then multiply? Because it seems to me that there could be areas of which you can intertwine what you're doing for the funding, the female and the underrated
Oh,
side of
absolutely,
things, and then
absolutely.
moving
Yeah,
that
no,
into
no.
add then
The
multiply.
and in fact, this new holding company that I'm looking to create, we're going to take Add Then Multiply and Funding Focus and merge them into that new company. So because it's really interesting. One of the questions that my coach always asks me is, well, how do you keep them? Why are they separate? The two of them, you're so intertwined in both of them, but how do you put them together from a business context? And I've really struggled with that over the last few years, and until it just kind of, I had this dawning realization. I took a week off over Christmas, which is wonderful, and literally off email, off work, just taking time to be present, and took some time to think about the business. And I was doing that as part of my annual reflection process that I'd go through every year. And I just sat there and I just went, yeah, it's obvious, but until I'd had time to just let my brain calm down and take a little bit of a break. What was obvious just wasn't there. I didn't see it. So again,
And
you
you
know,
know
that's
what?
that's an important.
I will come back to the second part of what you do because of that. But can we just now talk about this? It's obvious and it happens in a blinding flash. How do you hold space for your clients in those moments of reflection so that those eureka, those aha moments can come and move then everything together to the next level?
What what I've discovered is that those eureka moments come, and you have to, those eureka moments are available to all of us at just about any time. But if we've got noise going on in our heads, we don't hear them because those eureka moments are quiet. So we need to have that time for quiet reflection, that time for just pausing and taking a break, that time for being present and just having a calm mind rather than, oh my God, I got to do this and I got to do this and this was late and blah, blah, blah. Just take the time and have a calm mind, and that wisdom will bubble up. And sometimes it is an incredible eureka moment, and sometimes it's just a sort of a, I've been wondering about that, and all of a sudden there's the solution type thing. I mean, I go for a run twice a week. And I find when I'm running, I often, I just let my mind wander. I don't go out there thinking, right, I've got to work out this problem. I just let my mind wander. And I often find that during the course of my run, something will pop into my head that I've been mulling about over. And by not actively thinking about it, but just letting my brain go where it wants to go, it comes through to me.
You're letting it in from the quantum. I love it. I think this is
Absolutely.
fantastic. Yes. And I know
Absolutely.
I took you kind of off track. So let's go back then. There was a part two to
Yes.
add and multiply do. Bring us back
which is
to
which
the
is
part
yes,
two.
which is the FACE methodology: fund, acquire, consolidate, exit. So once I know that the client has a sound footing, I then work with them on the more advanced strategy, which is all about exponential growth. And just to put that into context, the first company that was listed on the stock exchange that I joined in at the beginning of 2003, and I was with them for just over 3 years. And when I joined, turnover was £1 million. 3 years later, when I left, turnover was £27 million. So we tripled the
Excuse
company,
me?
and we
You say
tripled the
that as if
company,
it were
and then
just
we tripled it again, and then we tripled it again 3 years in a row. Now that was a pretty intense period,
yeah.
and we acquired seven privately held companies and took over another listed company. And that was really where I cut my teeth on this whole fundraising and M&A strategy and executing
Absolutely.
those deals. And I certainly don't suggest that that's the right thing for everyone to go for. That company was in a unique position. But what I do say is, okay, so let's look at your business and let's look at the environment that you're operating in. And let's look at what might be a business that you could acquire that is going to be complementary to what your business is. So it might be that you're running I don't know, let's take something very straightforward. Let's say you're running oh gosh, something simple. You're running a local newspaper. Maybe that's a bad example because local newspapers are slowly going out, but let's run with it because I've got it there. So you're running a local newspaper, and so I live in West London. So here's the Ealing Gazette where I live. Well, that's great. That's a newspaper, and I know that Richmond has one, and that's a competitor. But actually, if I were to go out and buy the Richmond newspaper, I'd have two boroughs that are quite near to each other. So there's the potential for shared things. There might be opportunities to get shared advertisers, and maybe they've got some advertisers that I'd like to get into mine. So that could be an interesting potential acquisition. Or it might be that I actually go out and I say, well, look, I've already got a portfolio of three or four newspapers that I run. Maybe I should go and buy a company that produces newsprint because the actual paper production is one of the biggest costs of my business. So rather than going out and buying the newsprint from someone and paying their profit margin on top, why don't I just go out and buy their company, and then I can get the actual newsprint at cost. And then maybe after that, once you've got that in place and that's all running, you might want to look at buying a distribution company so that you can get your newspapers out to the marketplace. And this type of thing, Deborah, really applies in almost any industry where you just take what is it that you're doing and what is a similar business to what you're doing in a different geography, and it might be a different part of the country, it might be a different country entirely, and of course it's easier and easier these days to expand internationally with businesses. But the whole benefit of buying another company is that it has customers, it has suppliers, it has employees right from day one. It's already got all of that in place. Whereas if you decide, well, there's a competitor over in, there's a competitor in Richmond, but I'm going to go and send someone to Richmond and we're going to set up something in competition with them. And you end up having a big fight with them and you're starting from a zero base, whereas they've got an established business. So that can be a real challenge to build. Whereas if you go out and buy that company, you've already got an existing business, and then you can start looking at the synergies that you can apply.
Yeah. And then with your expertise as well, you'll be able to help people to look at, well, what is the best business to buy? What shape do they need to be in? What have they got? What are their
Absolutely.
balance sheets looking like? What is their
Absolutely.
culture? Because again, from the operational management consultancy that I've been involved in, a lot of it goes, and I'd love you to go into greater detail about this, about the culture of two organizations coming together.
Ooh, oh yeah, yeah. That's a huge one. That's a huge one. Before I do that, though, I just coming back to this concept, and this is something that a lot of entrepreneurs and small business owners don't always understand. Um, Oftentimes, they'll go out and they'll look for something that's cheap. And while it's great if you can get something that's not expensive, be very, very careful. And one of my business heroes is Warren Buffett. And one of my favorite quotes from Warren Buffett is that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Because the reality is, if you're going in and getting something cheap, there's something wrong with it. And if you're a turnaround specialist, great, go for it. But if you're used to running a successful business and you go in and you buy a basket case, you've got a huge amount of work to do to turn it around and get it fixed and get it up and running. And that's going to take your eye off your existing business. And there's a real risk that you'll have a problem. And it's interesting. I actually had an example of this when I was a young lad. When I was in my early teens, I had a job after school working in a local butcher shop, just cleaning up and washing up and serving customers and stuff. And the butcher expanded and bought another butcher shop. And that other butcher shop was a mess. And it took up so much of his time and attention that he very nearly lost his original business because he had to take his eye off that one to go on and look at the other one that he'd acquired.
Yeah, you
So I
work for
always say
two
to
masters. Absolutely.
I always say to people, focus on a business, go out and buy something that's good. And the beauty of it is that if you've got a good business in your sights and you've got a good plan and you know what you're going to do in terms of how you're going to acquire it, you can find people who will invest in you to support that growth. There is money out there to support M&A activities if you do it properly.
Mm. And also, as I go back, look at the culture as well of that
Oh,
organization,
yeah.
because toxic culture from one organization to the next and the two don't marry, and it is.
It's it's a disaster. It's a disaster. In my corporate career, after I left PwC, I was working for an American technology company called NCR. Probably best known these days for their hole-in-the-wall bank machines.
Okay.
Back then in the late 80s, early 90s, they were mainframe computers and retail systems. I mean, NCR originally stood for National Cash Register. And they were a reasonably successful technology company, and they got bought by AT&T, the US telecoms group. AT&T had tried, again, this was the early 90s, all of the personal computer boom and stuff. And AT&T had tried unsuccessfully to launch personal computers and entry-level computers and things like that. And so rather than carrying on trying to do that themselves, they bought a company that did them, and they bought NCR in what was called a hostile takeover bid. So the NCR wasn't supportive of it, and the board of NCR fought it, but ultimately AT&T offered enough money that the board had no choice but to accept the offer and recommend it to the shareholders, and the transaction happened. And Deborah, the culture difference between the two organizations was unbelievable. AT&T was very much, we've got these core values. They called them our common bond. We're very open. We're very supportive culture. We trust everybody. And NCR was a very command and control and political structure. And the two just when they came together, some of the things I saw in terms of just all of a sudden people who were used to command and control all of a sudden being trusted and nobody watching over them, and some of the shenanigans they got up to. And it's interesting because that deal, until some of the hype at the dot-com boom, was widely recognized as one of the worst ever M&A transactions in the history of corporate America. And
Wow.
it was all because the cultures were different.
Yeah. Yeah.
And
Just
and you
collectively.
know, another example I have was when I first started to get exposure to the world of M&A was I was with a PR agency group, and we expanded into Europe and bought 7 PR agencies, and then we ourselves got taken over. And the company that took us over, one of their main corporate customers was Kodak. One of our main corporate customers was Fujifilm. This was in the early 2000s, so before Kodak had its sort of demise. But Fujifilm was our client, and our new parent company, and we were merging into them. Kodak was their client company, and we knew that we weren't going to be able to keep both of them because of the conflict of interest. And whilst publicly it wasn't, privately the mantra of Fujifilm was kill Kodak.
Oh,
So all of
okay.
a sudden you've got these two clients in these two cultures, and it's like,
Warring.
whoa,
Yeah.
yeah, completely warring, completely warring. And I've seen that. And one of the things I often recommend to people when they're looking at putting companies together is, if you're the acquiring entity, spend time in the company that you're buying to spot talent that's inside of that company and offer that talent a position in the bigger group. Because then the people who are in that company are going to see someone and they're going, oh yeah, Fred was part of our team and he's now in the top thing. Or
Yeah.
Janet was our head of finance, and she's now the head of finance for the group, wider group. That's great. So that means they're
You've
really,
got the
they're looking out for the
relationship, the
talent.
interrelationships. Absolutely.
Exactly.
Yeah.
The culture, FACE, so it's fund, acquire, consolidate, exit. And consolidate is all about putting the companies together. And that's where the culture game falls absolutely squarely in there. And that's, as I say in the book, that's really where the rubber meets the road. That's where a acquisition will either succeed or fail, is in how you put the companies together.
And from the operational management consultancy side, we saw a lot of years of
Yeah.
stagnation, and we were
Yeah.
brought in to accelerate this development of this new entity. And literally, I mean, it can be chalk and cheese. Still, people were the old company and they didn't want the new one taking over, and lots of
Very much.
politics going on.
Absolutely. Yeah.
Because a lot of it's based in fear, you hear things can, and they think, well, they're not going to need
Oh
two
yeah.
of them or three of them or what have you, so what's
Yep.
going to happen to me?
Yep.
Yeah.
Yep. And that's the other thing. The other advice I always give is communicate, communicate, communicate. And
Mm.
and and one friend of mine says, whenever you're dealing with a change program, you have to tell people 7 times before it starts to come through.
Yeah.
So always communicate, always be open, always be transparent. And if there's going to be bad news and job losses, get them done and over with right up front, and then move on.
Totally. David, wow. I mean, this is just awesome. And we could talk all day, but I'm conscious of your time. What would be your parting words to an organization which is thinking, right, this year, we're really going to go for it? What would you say? Go on. These are the top things that you need to be thinking about to make that
Well,
successful.
the top thing you need to think about is get a copy of my book. Add Then Multiply. I've also just launched a scorecard, which I'll give you the link so we can put that into the show notes. And the scorecard, it's 20 questions across a number of different areas, all about readiness for this kind of growth. It's called the Funding Fitness Index. And we've literally launched it this week. So that would be a great way to have a look at where you're at and get an independent assessment of what your business, what the state of your business is across a number of different areas. And reach out and connect with me. You can reach me through my website, Add Then Multiply, or through LinkedIn, David B. Horne.
Do you know, David, please do. I would say this from the bottom of my heart. Please do be in touch with David. This man's intellect, his reason, his wisdom is second to none. He stands in major auditoriums giving the gift of what he does and contributing and adding value to business people's lives. He is a man to speak to. If you don't do anything else, get the book, get that Funding Fitness Index, because ultimately this is all our time to shine. David is a beautiful human being. He's got an open heart. Don't worry if you're not quite sure what you've got to do. He'll guide you through, etc. So please do be in touch, because I've spoken with David before we were on the show, and I can absolutely say this guy walks the talk. He's amazing. So David B. Horne, thank you
Thank you.
so much. I tell you what, you did not disappoint. It has been an absolute pleasure to have you on the
Thank you, Deborah.
podcast. My
Thank you.
pleasure. Thank you. And to everybody listening, wow, wasn't that just so special? Just incredible. There are thousands of pounds worth of value that David has given us today. We're so privileged that we can hook onto YouTube and your chosen channel and just get this all for free. It is just awesome. So everybody listening, thank you so much for your support. It's been wonderful to give you this amazing episode. Until next time, carry on caring and see you all again very soon. Thank you. Bye-bye now.